Good morning, it's Ian Coleman from PIA-First. It's Monday the 16th of April 2018. Today we're going to be looking at the FX majors. We're also going to look at the dollar index, break down the time frames to try and get a bias for the major currency pairs going into this week. Over the weekend we had the US, France and the UK retaliating for the chemical attacks in Syria. We did see a higher open actually in dollar yen, which was quite surprising, but that gap has now been closed and we are moving to the downside. We are quite bearish on most yen crosses this week, and it is going to be sort of the currency pairs or currency crosses that we're going to be concentrating on in most of our currency reports. Euro Swiss is also looking pretty prime for a move to the downside. So we're going to cover that cross currency as well. So briefly, going to discuss the dollar index, breaking down the time frames. The monthly chart highlights the index to be in a large bullish channel formation, and quite an impulsive move to the downside since making the 103.82 high back in the beginning of 2017. Now we are seeing little net movement, if you like, in the index as we're consolidating within this this monthly Ishimoku cloud. If we go to the daily chart, we can see that this last leg lower looks to have completed a bearish Elliott wave formation, stalling close to the 261.8% extension at 88.20. Impulse move to the upside, but only to be rejected and a bearish outside day posted close to this previous support, which then becomes resistance. We've seen very mixed and volatile trading in the index. In fact, we've had 31 days of mixed results, and it's only until we break down to a shorter time frame. This is actually the 8-hour chart, that we can see how volatile this price action has been. Now, there is scope for further losses in the dollar index this week. We've got the channel base coming in around about 88.75, and that is close to this 78.6% pullback level at 88.82. So we're looking for that to be the main focus for the dollar in the next few days, possibly running into next week. Now, obviously, if we reflect lower dollar bias onto most of the major currency pairs, that means the euro dollar to the upside, sterling dollar to the upside, dollar CAD obviously lower, dollar Swiss lower. We're going to be more aggressive in our bias for lower dollar Swiss than we are actually in our bias for higher euro dollar, and that's because we've got that correlation that means that euro Swiss should move to the downside. But anyway, let's break down the time frames. First time frame is the monthly chart, euro dollar. Here we're in a bearish channel formation. We've got trendline resistance at 126.38. We've also got this 38.2% pullback level at 125.22, and rallies up to there keep on being capped. But I think this level is going to be key this week, and the shorter time frames are going to explain why. So if we go to the daily chart, here we've got two bullish channel formations. So let's just put a trend line on that level, 126.38. Okay. So we've got two bullish formations here. We've either got a corrective channel formation that has a bias to break to the upside, so looking to break through 124.36, or we've got a symmetrical triangle formation with dips being bought again and a break of 124.36 confirming. So although our immediate bias is to the upside, we'd only look for really a rally up towards this sort of level this week. Sterling dollar, and that's sort of playing out with what we were expecting in last week's video report. The weekly chart, or the monthly chart, sorry, is highlighting inside bars. they are a clear indication of investor indecision. Bespoke resistance is located at 143.84. We're not looking for a move above that level, but we do believe it's a key target level for sterling dollar this month. If we go to the weekly chart, here we can see that we've got a bullish channel formation that we're holding on to quite well. Previous swing high is located at 143.46. 261.8% extension level is 142.11. We look like we're going to surpass that again, and I believe we're going to get a fifth wave extension up to this 143.84 level. And in fact, if we go to shorter time frames, similar setup to what we're now seeing in euro dollar, is that we've got a corrective channel formation. We're probably going to break to the outside. Sorry, we have broken to the outside. We haven't had a retest, which is actually what we were looking for today. And we're seeing a continuation of this trend. Now 143.84 is our resistance level, and then above that we've got this 261.8% at 144.84. So immediate bias is bullish, but only up until this zone here where we're expecting sellers to return. Dollar Swiss monthly chart looks to be forming a descending wedge pattern as a bias to break higher. A break of 99.03 and 103.39 is the measured move target. Daily chart really gives, which we'll show the weekly chart to start with. That sees the last move to the downside, stalling and buyers emerging underneath this 261.8% level. That becomes a little bit clearer on the daily chart, where we've got a bearish Elliott wave formation, so down in 5, buyers re-emerge, and then we've pushed higher quite aggressively really in this bullish channel formation, and that in turn has seen quite an aggressive move in those two Swiss crosses that we were talking about earlier, Euro Swiss and Sterling Swiss. However, 96.84 is our bespoke resistance. We've then got a 61.8% pullback level at 97.13. So we're looking for that zone to cap buying this week, with a stop placed above 97.67. That offers quite a good risk-reward trade, with 93.50 being prime support going into this week. Dollar yen monthly chart, a potential bullish head and shoulders pattern. I'm having to say potential because it needs a break of 127.50 to confirm that outlook. The daily chart highlights again a 261.8% extension level at 104.54. Elliott wave pattern deemed to be complete down here. However, if you see this little small dotted line, this is actually our bespoke resistance coming in at 107.80, and levels above there on Friday actually got sold into. So it wasn't quite above there, as 107.78 was the high trade on Friday, and we're now expecting at least a corrective move to the downside. So we're looking for this pattern to potentially form this week. This trend of higher highs we believe is a neckline, and then a move lower to this channel base around about 105.90 could potentially make a bullish reverse head and shoulders, but it is our prime support. Okay, 106.62 is first support, which has been quite pivotal, and then 105.90. Dollar CAD, not a very clear picture in dollar CAD, but we're having to consider that dollar bias. But obviously with dollar CAD as well, we also have to consider oil. The weekly chart looks like an ending wedge pattern. Again, we need to see a break of this level here, which is, I mean, it's about 131.70 probably this week. Let's just drop it down a bit. 131.56. So we need to see a break there to take this currency pair higher. Shorter time frames, if we look to this weekly chart, it actually highlights a move lower from the 61.8% pullback level. So we're getting sort of mixed views in dollar CAD. This does look like a corrective channel formation at the moment. We've also got, if we go to the daily chart, a 61.8% pullback of this impulsive move. So there's a real sort of mixture of different outlooks, if you like, in dollar CAD. The immediate bias is selling into rallies because of that dollar index outlook. 126.62 is short-term resistance, but with this much indecision around this 61.8% pullback level, I think there's better currency pairs to be playing this week. But like I said, immediate bias is to sell into rallies. Long-term bias is to buy into dips, but we've not seen any prime support as yet. Aussie dollar monthly chart, huge expanding wedge formation that has an eventual bias to break to the downside. This whole move up from the beginning of 2016 looks corrective. The weekly chart looks like an ending wedge pattern. Again, we need to see break of support to confirm that's coming in around about 76.20 this week. Holding within the weekly Ishimoku cloud, that normally means that daily results are pretty mixed and volatile. Could be an ending wedge. This is quite an important candle. Friday's candle posted a 13 count, a DMARC 13 count. Now that normally means that the rally is coming to an end and we should see a move to the downside. However, a DMARC stop, which is obviously a very important part of all trading systems or analysis, is calculated by taking the length of that candle and then putting the length of that candle on top of the candle. So it would put the stop for that sort of sell outlook, if you like, all the way up at 178.80, which is a bit rich, especially considering risk reward is only down to sort of around about 76.50. So what we're looking for is we are looking for rallies to be sold into, but we're actually looking at this 38.2% pullback level at 78.32 this week. Euro sterling monthly chart, bearish outside bar, breaking through support. Really, the longer time frame, we'd expect a move down towards this sort of level, 83.03. However, the daily chart, let's just get the daily chart up, highlights a doji style candle, again a DMARC 13 down here. So really dips potentially bought into at the start of the week. First resistance is at 87.04, and then the second resistance is at 87.58. There is potential, easy potential for a move up here, especially with the shorter time frame. Have I got it up at the moment? Nope. Let's just remove these. Looking like a reverse head and shoulders pattern. So if we just put the trend line on here, okay, so breaking out to the upside of a potential reverse head and shoulders. So left shoulder, head, right shoulder, and then a move higher. I mean, the projected measured move target for this very small head and shoulders pattern is not massive. It's 87 the figure, and if we break down to the daily chart, 87.05 is our resistance. So we're expecting, if we do get a move to the upside in this currency pair, that it's going to be pretty mixed and pretty volatile this week. Euro yen, this was our trade of the week last week. Breaking down time frames, bearish outside month posted in February. Marubozu level at 132.76. That's been capped in Friday's trading. And if we break down to the daily chart, we can actually see here an A, B, C, D formation lining up pretty well with that 132.76 level. Now, we've only seen a correction count on the daily chart, not an exhaustion count. So a correction count is a 9 count. That normally means that we will see at least a move to the downside. An exhaustion count normally means that the rally is finished. So there's still scope for dips to be bought, but we are still looking for this rally to get exhausted this week. And obviously next upside resistance is at 133.22. Which is a 38.2, which is the 50% pullback level of that last aggressive move to the downside, 137.48, 128.95. So last look is basically going to be Euro Swiss. Now, this is the 8-hour chart. Let's actually turn it into a daily chart. Okay, and we've seen an aggressive and impulsive move higher. Inside bar posted on Friday, and then we are potentially just dip buying, if you like, at the moment. Now, the most important factor on a bearish outlook for Euro Swiss is that we've seen a weekly 13 count on D-mark. It would mean having a stop at 120.11. So obviously, with that being right up here, we don't really want to be sort of selling into rallies, but we are looking for short-term topping formations in Euro Swiss, and we haven't got any as yet. I mean, there's a potential for this to be a wedge, but I think we're sort of really trying to force a pattern, if you like, on that pair. If we get a breakdown below 118.38, then prime support is going to be down here, 116.60 this week. Okay, hope you enjoyed the video analysis. If you have any questions, please feel free to ask or post them. And enjoy your week, and we'll see you again next Monday. Thanks very much.